Hi, my name's Tom Elliot and welcome to another financial markets update for Hodges Real Estate. Well, residential property at the moment is undoubtedly on a bit of a roll. Now, we've only had a few weeks of the 2014 selling season, but clearance rates continue to exist around the mid-70s, which is the sign of a very healthy market. And of course, you always need to remember that the 20 to 25% of houses that don't sell at auction each weekend usually sell within a week or so afterwards. However, and there's always a but, there is both good and bad news on the economic horizon. Well, let's deal with the good news first. Now, local interest rates remain very low. The Reserve Bank has probably stopped easing rates, but it's in a holding pattern at the moment. And that's good news. It means you can predict what interest rates will be. Again, though, as I've said many times in the past, if fixed rates offer you a discount to variable rates, I'd be inclined to have a serious look at them because I don't see the variable interest rate being cut anytime soon, if at all. Secondly, the American economy, it continues to rebound from the lows experienced during the global financial crisis. Unemployment during 08-09 at its worst in America was almost 10%. Now it's back down to 6.6% and it continues to fall. It's fallen so much that the US Federal Reserve, the American Reserve Bank, is now considering its money printing and interest rate program, and that's a good thing. It means that the American economy can possibly sustain not having to be given tens of billions of dollars of free money every month. Thirdly, the share market, it's in excellent health. I've got to say the Australian share market has recently hit a 6-year high, again rebounding from the lows experienced during the depths of the financial crisis. We've recently had the interim reporting season and many of the biggest stocks on the Australian Stock Exchange reported good to very good results. I speak of course of the big four banks, Telstra, BHP put in an excellent result for example. Also some of the infrastructure stocks like Investra, they're all doing just a bit better than what people had predicted. And when you exceed the market's expectations in terms of sales and profits, share prices tend to rise, and that's what we're seeing at the moment. Having said that, we are still a fair way off where the share market was in late 2007. So unlike the American share market, the Australian share market is yet to regain its all-time highs of around about 7 years ago. Also from the media sector, now some of you may know I do a fair bit of work in the media. 2014 is predicted to be a fair bit better than 2013 when it comes to media spend, particularly when you look at the traditional media of radio and television. Channel 9, for example, recently refloated on the Australian Stock Exchange. Although its shares were sold down at first, they've rebounded. And also the company for whom I do a lot of work, Fairfax Media, which in Melbourne publishes the Age newspaper, in Sydney, the Sydney Morning Herald, it recently shocked the market with a much better than expected profit result, and its shares jumped up quite considerably as a result of that. So that's obviously good news. And finally, I think of the good news front, notwithstanding all the talk about stopping the boats and filling up detention centres and so forth, our population continues to increase as net immigration remains very, very strong. Okay, so what's the bad, or should we say not so good news on the economic horizon? Well, firstly, of course, we've seen, and it's been well publicised, several large companies, international companies, saying they're going to shut up shop here in Australia. Now, late last year it was Holden, about a year ago it was Ford, most recently Toyota. Shell is looking at, well, it's sold its refining operations, although the new owner says it will keep the refinery going. Alcoa, of course, is going to shut down the Point Henry aluminium smelter. SPC had a near-death experience, although its owner, Coca-Cola Amatil, has convinced the Victorian government to pump in $22 million of our money to keep it going. But obviously, all these companies pulling out, all these job losses that are going to happen in the next few years aren't good for confidence. And of course, the Geelong region in particular will be hard hit by these job losses. Secondly, Joe Hockey, I think, is setting us all up for what we might call a bit of a horror budget in just 3 months' time. Now, Joe Hockey is very worried about what he calls the structural deficit. The fact is, on its current settings with big picture things like Medicare, welfare, tax revenue and so forth, budget deficits are set to get bigger and bigger and bigger with no end in sight in the future. The only way to stop this and to stop the national debt continuing to increase is to make some big cuts in spending and possibly introduce some tax increases. And there's all sorts of ideas being floated out there, whether it's a fee to go and visit the doctor, whether it's means testing of Medicare, I don't know. We'll find out at the budget. But all I will say is the federal budget is going to be a net drag on economic growth. It's going to have to cut spending and increase taxes. Also, I mentioned interest rates before. I mean, the good news is they're very low, but the bad news, if you want to call it that, is I really don't see them going any lower. So people have to factor that into their consideration. Also, local inflation, unfortunately, is starting to rise. The most recent inflation figures suggest that inflation could soon tick above the 3% per annum mark, and that is danger signs for the Reserve Bank. traditionally when this happens, the Reserve Bank increases interest rates. It doesn't want to do that at the moment because it's hoping the Australian dollar will fall further. But if inflation continues to rise, it is going to put the Reserve Bank in a real pickle. And one of the reasons it is going up is the A dollar. The A dollar, while still high on an historical basis, at 90 cents US where it is now, is a lot lower than $1.10, $1.11 just 18 months ago. And that means that quite a range of imported goods are starting to go up in price here in Australia. Unemployment also is starting to go in the wrong direction. We recently saw the national unemployment rate tick above 6%. It's below what the American unemployment rate is at 6.6, but whereas the American unemployment rate is falling, our unemployment rate is going up, and sadly I think the two are going to meet fairly soon, and that would have been something that would have been unimaginable just a couple of years ago. And finally, consumer confidence, I reckon, is so-so at best. Curiously, business confidence is quite strong at the moment, but when it comes to spending, although the Christmas sales and so forth were quite good, consumers still show a marked reluctance to put their hands in their pockets unless things are being heavily marked down, unless the sales are on. So, what do we conclude from all this? Well, residential property had an excellent year in 2013, up over 10%, again, depending on which market, which area you're looking at, but 10% was a good average price increase. Frankly, for 2014, I do think we'll see another increase, but I don't think it will be 10%. I think 5 or 6% is probably the best on average that people can look forward to. But again, it depends on the individual property and whether or not you decide to sell, for example. Further interest rate cuts are only a possibility if there's an economic crisis, and that really would be a two-edged sword, because the crisis would have to be so bad that the Reserve Bank was forced to change its tune on interest rates. We really don't want that. So I'm hoping interest rates stay the same, because that means the economy stays on a relatively even keel. And finally, I would just say that I think people, in terms of the repayment budgets, whereas in the past couple of years you could reasonably hope that your interest rate payments on a mortgage would drop possibly next year over the present year, that is no longer the case in Australia. I really do believe that the interest rate settings we have now are as good whether you're the government, whether you're a big business, a property trust, whether you're a property investor, or just a typical mortgage holder that owns the family home. Now is as good as it gets on the interest rate front. Okay, that's all from me. I look forward to your company next month. I'm Tom Elliott. This has been another Financial Markets Update for Hodges Real Estate.